Okay, so I just happened to come prepared with my little slide of what is SRI, and there's a whole bunch of different names in here. So sometimes this field is called Sustainable and Responsible Investing, SRI. Sometimes it's called Socially Responsible Investing, SRI. Sometimes it's called Environmental, Social, and Governance, ESG. Sometimes it's called Value Investing. Sometimes it's called Mission-Related Investing, Slow Money, Green Investing, Community Investing, Values-Based Investment, Ethical Investment, and now your head should be spinning. And you need that little umbrella to protect it. Really, from US CIF, which is the member association for firms like Trillium and Boston Common and Aperio that do sustainable and responsible investing or ESG investing of some sort, it's really about the consideration of environmental, social, and corporate governance criteria in addition to standard financial analysis. Notice we did not say to replace traditional financial analysis. And so that old canard about all that people in SRI care about is excluding things. I just want you to kind of move that aside and think about in addition to traditional financial analysis. So it's adding something to your knowledge, adding something about the totality of what the institutions or entities that you're investing in are doing and what their impact is. I'm going to go back to an earlier statement. All investing is impact investing. What we're trying to do is be aware of what the impacts we're having are and whether those impacts are in the direction that's consistent with the mission of the organization, that's consistent with what the values of the investor are. Every investment has an impact. Question is, do you know what all of those impacts are and what are the impacts? So this is a little timeline on the history of SRI. I'm just going to use SRI as the shorthand for all of those terms that were under the umbrella. So I'm going to start way back in the 1900s, and that's actually probably a little bit late to start. But there were investors before that. Our keynote speaker at lunch talked about people thinking about should their religious organization hold slaves. That is a criteria along this line. It's an investment. It was unfortunately perceived as capital investment in people, but it was seen as an investment. Does that make sense? 1900s, we begin seeing religious investors, including the quote-unquote sin stocks, tobacco, alcohol, gambling. Also see some Quakers or the Society of Friends excluding weapons, armaments, as something that's not consistent with face values. 1966 saw the first shareholder advocacy campaign against a Rochester darling, Kodak University. 1971 saw the first SRI mutual fund, the Pax World Fund, and by that name, Pax for Peace, very interested, started by a couple of people of religious background, very interested in the issue of weapons, among other things, and how did that fit? Sullivan Principles, 1977, asking corporations to look at the effect of their behavior, their investments in South Africa on apartheid and on the black population of South Africa, what the effect of that would be. Plug for my own firm, 1982, Trillium's the first dedicated SRI investment advisor, only exclusively to that for separate accounts. 1986, Coca-Cola withdrew from South Africa. So notice the difference there. 1977 to 1986, you have a 9-year period between when the Sullivan Principles were formulated and you have the first big company to announce that they're going to divest. And notice, divestment from South Africa, you're asking a large corporation to stop doing what was 5%, 10% of business. The ask on fossil fuel is stop doing your whole business. So that's one of the challenges with that divestment movement. 1990, the Domini Social Index was created. This begins to address the question of performance and what's the performance of 2006, UN Principles for Responsible Investment created. 2012, 350.org and the Fossil Fuel Freeze and Divestment campaign started. Throughout all of this, what you see is there are times when you can say, well, investing in tobacco helps your portfolio. Investing in tobacco did not help your portfolio. Investing in weapons is really, really good when you have a build-up to a war. It hurts your portfolio when you're not in a build-up to a war. The same thing for fossil fuel. I don't want to put out the idea that because oil prices are down today, that that's an argument that a student wants to take to a trustee. You want to find an argument about incorporating the values that doesn't depend on today's prices versus tomorrow's prices. Look for an argument that has a long-term arc to it, not a short-term market movement, because it is absolutely certain at some point that fossil fuel prices will do somewhat better than the market. If you want to take a short time period, you can take the last 2 weeks in January when fossil fuel stocks did great. So depending upon what time frame you choose, you can find a time when anything is doing better or doing worse. So part of this whole history here is a whole industry dealing with what are we doing, what are values, how do you incorporate them, what difference does it make, how do you do it, what are the tools that you use to do it, and a whole industry and a whole group and a whole movement really growing in their ability to address these issues. So that's your brief history of the world in 3 minutes.
Thank you. And I wanted to turn it over to Lisa to start talking about some of the tools that Cheryl was just mentioning, and what are the actual ways outside of screens, which is primarily what we've been discussing when we're talking about divestment. What are some of the other tools in your toolkit that you can use when you're trying to align a portfolio?
Thank you. So I think as we've talked about today, it's been very, very focused on divestment and screening out companies, or even potentially screening in companies. So looking for companies who are to display or have characteristics that we find appealing in terms of how they treat their employees or their human rights stance or their environmental footprint. But there's another set of tools, I like to call the tools of the trade, which we have available to us as investors. And I think it behooves all investors to use them. And they're active ownership tools. And what that means is when you own shares, whether it's via a commingled vehicle, through a mutual fund actually, or the kinds of, a commingled vehicle is essentially a mutual fund for an institution, as opposed for an individual. Or you own stock directly, you have certain ownership rights. You have the right to vote at the annual general meeting, for example. There's a slate of resolutions that will be presented, and you can vote on them as a holder of those shares. And as an owner of the shares, I like to say share owner, not just, we should be exercising the rights of ownership. What by that I mean, our view is that attention to environmental, social, and governance factors is smart. It is financially sensible, it helps in risk mitigation, risk reduction, and will actually result in better long-term financial returns. And we want the companies we invest in to behave in a way that's consistent with that. And one of the ways we can support them to do that is using these active ownership tools. So proxy voting and filing shareholder resolutions are two of the tools you might have heard of. So proxy voting is just doing that. It's voting your proxies. So if they have a vote around the compensation of the executives, you can vote against if you think the compensation is outsized. And in fact, more investors should probably do that. They should pay attention to what's being put on the proxy. Similarly, you can vote, or rather you can file a shareholder resolution. You need to have held the stock for a year. You need a certain dollar amount, $2,000 I believe is the amount that you need to have held. And that allows you to file a shareholder resolution. And I know that Trillium and my firm Boston Common has filed several shareholder resolutions. Sometimes just the mere act of filing can bring the company to the table for negotiation. So I work on the issue of boardroom diversity and women in senior management for Boston Common, and we're currently in a negotiation with Discovery Communications. That's a media company, and unfortunately it has no women on the board. And it's actually an outlier compared to its peers. So one of the things that I do is I review all the holdings in our portfolio in order to identify companies that might be appropriate to engage in dialogue on the issue of boardroom diversity and women in senior management. So in fact, Trillium and another of our peer firms has filed a shareholder resolution with the company. We ourselves hadn't held the stock long enough to file, but we've written to them several times. The reason it's really interesting is Discovery Communications owns the Oprah Winfrey Network. So I also wrote to Oprah. I have not heard back from Oprah. But we have gotten a response from the company asking for a meeting in order to discuss our resolution. Our resolution is asking them to look at their nominations committee. they actually changed their nominations procedures a few years ago to basically to say they'll look broadly at all candidates. That was a weak change, but it was a change. Now we're like, well, we think that's great, but we'd really like you to put in more inclusive, more positive language about seeking candidates with a diverse background, particularly because it's a kind of board of cronies. So in this case, we're hoping we can withdraw the resolution before we come to the AGM. We'll see. Keep you posted. In addition to that, there's dialogue. So those are kind of formal legal ways for us to kind of get the attention of company management. But you can also email them, call them, send them a fax, and ask them for a meeting, a discussion around a social, environmental, or governance issue. And I think if you're going to seek out a dialogue with them, it's great if you work in collaboration with other investors to raise issues, and it's great if you really know what you're talking about before you ask for that meeting, in order to actually come to the table and say, if the company says, oh, we do this, and you can say, no, you don't. We've checked, and you don't do that. Here's the evidence that we found. And some companies are more receptive than others. One of the things that my firm does, because we are global investors, is that we work in collaboration with a lot of investors around the world, because we're often trying to dialogue with companies in Europe or Australia or Canada, because that's where I'm from. And I think that's also, it's another way to demonstrate how important these issues are to a broad range of investors by working in collaboration. And I think another thing I just wanted to finish off with is that I've been told by staff at companies that we have targeted, and target isn't the wrong word, because we are investors first and foremost. We manage money on behalf of endowments, of foundations, and we need to deliver returns so you can do what you need to do with the results of that management. So we're professional investors, but we also don't work in a vacuum. We have social beliefs, we have concerns about how companies manage themselves, and we actually want to strengthen the hand of those progressive forces within the companies that we own. And we have gotten feedback from companies, or for staff within companies, who said, because you sent that letter, I got a meeting with the CEO who asked me, what are we supposed to do about this? 11 different investors have written us about this. So I think it's engagement, which is kind of the broad terminology for this. It can't change a company's main raison d'etre. It's not going to change. An oil company's not going to become a solar company as a result of engagement. But it can improve processes and procedures and really get the company to pay attention to social and environmental concerns and really embed long-term thinking in company management and strengthen those people within the company who are already trying to work on those issues. So I think that's the thing to keep in mind about engagement. Thanks.
Thank you for that, Lisa. I wanted to turn it over to Liz next to actually answer a big question that has been floating around that is short but very, very nuanced. One of the things that folks wrote when they were coming into this space was, doesn't investing with your values mean you're going to lose money? And I wanted to turn that over to you because I know that that's a small question with a big answer.
So some of you may be familiar with our firm, Aperio Group. We did the analysis on behalf of 350 and Responsible Endowment Coalition about 2 years ago when the question first came up, what is the cost of divesting our portfolio? And what REC and 350 were looking for was an investment answer. How do we quantify the risk? We're being asked the question and we don't understand it. And so that's how we got involved in this. And I want to be clear, we are agnostic as to whether divestment is a good or bad. There are a lot of different ways for values to be reflected. But if you are going to do it, there are ways to think about it. And in the investing world, risk is a big one. How do you think about what your actions are vis-a-vis the investment portfolios, and how is that going to impact return? And there are different ways that risk gets measured, and it's important to understand that. I'm not going to give you a statistics lesson right now, but understanding the difference between standard deviation and tracking error, these are all terms that your investment committees are thinking about. So when Alice talked earlier about how does my performance compare to a benchmark, it's all about that. That's the question. Underperformance and overperformance are relative. So understanding that. Time is also a really important issue. All of us as managers are subject to what have you done for me lately? What does my performance look like this quarter? All of us, whether it's Prime Buckles or Mercer, you're sitting in quarterly meetings with your clients explaining about this performance, which is important to understand. So there's always that bogey that people are looking at. Nobody ever complains when you're outperforming, ever, ever. You underperform and all of a sudden you've done something wrong, even if your strategy is exactly the same, okay? So understand the pressure the investment committee is subject to because every year they've got to deal with their 5%. So these are all very real issues around how you think about performance. So when we look at it, the question is not what are you not investing in, but what are you doing with what you've taken away. So if I divest from my portfolio and I now have $10 million, I'm not sticking it in my mattress, you know, at 1% or 1.5%. Or 0%, where you're sticking it. Yes. So all of those things, you're not doing that, or at least I assuming you are not doing that, right? So you are doing something with that. Presumably, your managers and your investments are doing something thoughtful with it. Okay. All investment is impactful, but all investment is thoughtful. There is something going on around it, so it's important to understand that as well. Some of the math that's coming out, whether it's Dan Fischel's post in Washington Post or wherever it was, or some of the other reporting, seems to make the assumption that you've just taken it away and stuffed it somewhere. So that's just not the case. In our case, when people ask us to divest a portfolio, we do something that's called re-optimize. So we take it and spread it out across the market in a way to continue to track the benchmark. Okay? That is one approach. My colleagues and other folks, they make a decision that these might not be things they want to be in, so they might choose other industries, other things in energy to get to the same place. So all of these are really important. And one, I will take this opportunity to advocate for something because we get asked this question all the time as you guys are looking at reports and you're getting pushback. You're in an academic institution, most of you in liberal arts places, right? You are taught how to analyze. You are taught to be critical thinkers. And your institution should respect that because God knows you're all paying a lot of money to be there to learn that. When people are giving you answers and the assumptions and they're not properly footnoted, ask the questions. Understand the assumptions that are going into all of the costs and all of it. Nobody expects you to be investment experts. But on any topic, all of you have learned how to ask critical questions. And you'll learn. And it may be that you come out at the end and you go, you know that $30,000 that we'd have to pay to transition to a more expensive fund? Yeah, I'd rather that go to another scholarship, but what else can we do? So it was a long-winded answer to your question, but I feel so passionately, ask the questions these people work for you. Not your universities, but your investment managers and your investments. Ask the questions. We all owe you at least clarity and transparency around that.
Thank you so much for that. I wanted to kind of dive in really briefly to this concept of fiduciary responsibility. That's something that also has been floating around the room all day, and I believe Cheryl actually has some visuals that might be able to help with that, but wanted to throw it out to all of the panelists if you wanted to tackle the question of what is fiduciary responsibility legally, and what does that look like? How is it interpreted in different spaces?
Thank you. So I do have 3 different slides, and the key thing to understand is a fiduciary is someone who acts in trust for another. So as a fiduciary, the trustees of the organization are fiduciaries for the organization. They're managing the money, they're managing the assets on behalf of the institution. Now, the concept of what constitutes good fiduciary practice changes over time as the investment universe changes, as practices change. What would have been seen as a very prudent way, and that's another word you hear a lot, we have to be prudent. What was a very prudent way to manage an endowment in 1950 would be seen as completely imprudent now. There are different techniques, different abilities. So fiduciary practices respond to changing circumstance as investment tools evolve, as theories evolve, as economic, environmental, and social circumstances evolve. And the really key element is no single enduring theme that's there. Now this is a slide, I'm sure it's very hard to read from back there, but what I want to make the point here is these are 3 different pieces of kind of official information about fiduciary duty and specifically about incorporating environmental, social, and governance criteria into that. So back in 1998, the Department of Labor wrote to Calvert Organization, which is a sustainable, responsible investment firm, and gave them the advice that they could say to fiduciaries, it's okay to use an ESG criteria or an SRI fund as long as its characteristics are similar to other investments. So that's the first, it's permissible language, 1998. 2005, Freshfields Bruckhouse Derringer, which is a big law firm in the UK, did a study for the UNEP Finance Initiative that said that the links between these ESG factors and performance are becoming more and more recognized. And looking at that and looking at the effect of those impacts that you're having with your investments on the world that your institution is operating in, it is clearly permissible and arguably required for trustees to take this information into account. And then the Prudent Practices for Investment Stewards, which was published by FI360, an organization that does trustee education, says, this is a little bit later, that the investment policy statement should define appropriately the social and environmental contexts in which this happens. So you can see the progression over time from, well, if everything else is equal, you can do it, to, well, you probably should think about it, to, you should do it, evolving duties over time. Most recent statement of trustee responsibility is UPMIFA, which is a very long acronym, but basically they're trying to define what is prudent practice now. And in that most recent discussion by Uniform Practices for Fiduciaries, they must consider the charitable purpose of the organization. So again, that mission, what's the mission of the organization? You have to have that, that's the beginning of your investment policy statement. What are you trying to do? And how you arrange your investments relate to what it is you're trying to do? And I'll turn it to the rest of my panelists there. Other comments?
I felt the need, as you were going through the history of the prudent rule, that up until relatively recently it was officially called the prudent man rule. So, 50% of us were apparently not obligated to fulfill it, but.
That's something, if you have any further questions for fiduciary responsibility, feel free to write them down. We're going to get into Q&A in about 5 minutes. I've got one last question pre-planned, and then we're going to open it up to all of you. This last question, because we've been talking a lot about the process, and I know a lot of people here probably have questions about timelines, have questions about best practices as well for engagement. So I wanted to open it up to all 3 of you to talk about what does the timeline look like for reoptimizing a portfolio? What would it look like to implement positive and negative screens? And maybe if you have any experience involving unique stakeholders for institutions that do have clear missions and responsibilities to outside community members, what are some things that you do to include their voices in the process?
Sure, so I can start. In terms of a time frame, as Alice said earlier, it starts with the investment policy statement and then seeking to get whatever sort of mandate to a manager. Once we get that mandate, once it's been defined, that process is very quick. The things that take time are the disposition of the assets you're currently in, depending on how that's moving across, and any other of those pieces. The other piece that takes time is before you can even get to the investment policy statement is what is your mission? What do you want to reflect in your portfolio? And that part of the discussion can take a very long time, particularly in a university situation where you have multiple stakeholders. You have the staff, which can include the investment committee. You have students, which is a sort of a constantly revolving door of people. you have faculty, you have alumni. And so all those people have to be engaged in some way, shape, or form. And just the way those schedules work, it can take time, which is often not something students want to hear because they want things to happen very quickly. I will share, and sometimes it moves much faster, but it's, you know, think in terms of years, usually not months. We did work with one university, and this was, I thought, particularly interesting. They had decided to divest. That was sort of where they started this. They had worked with the students and they came to that decision. But then they realized it wasn't just about climate change, that this was a campus of diverse constituents, and there may be other issues that were also important. You know, there are diversity issues, there are private prison issues, there are human rights issues. There's a wide variety of things that different people view as important. So what this particular university did was they went out and they surveyed their entire community. Now, several thousand people, it's potentially very risky, but they were very clear about the decision-making process. This was not a democracy. It wasn't, whatever gets the most votes will get implemented. Think of it more as an informed autocracy. And they took the information in and they built that in. So they had a way of engaging a very large number of players, and that's what they ultimately ended up asking us to reflect in the portfolio. So it wasn't just environment. It did include social and governance issues that the community at this point in time felt was important, and that presumably the investment committee and the board felt was not today's issue, and next year there was going to be a different set of issues, that these were long-standing issues that they felt they could get behind. So that's one example. It's the only time I've seen it, but I thought it was worth sharing.
I've got two examples. One is a private engagement and one is a public engagement around timing and how long it takes. So the private engagement is really about what our clients have access to. So if you're a client, we will invite you to participate potentially in a meeting, in a conference call, if you want to. And the time that takes depends on the decision-making process your organization has to decide whether you want to participate and to what degree and who within your organization is going to represent you. So the example I have is only a couple months after I started, the chairman of GlaxoSmithKline, which is a big pharmaceutical company, came to our offices. We are a small firm. So it's quite unusual for that size of a company's chairman to come to visit us. But we had a collection of investors who were meeting with Sir Andrew Whitty. And one of the things we talked about was a group called ALEC. I don't know how many of you are familiar. Yeah? Okay. So we had lobbied, essentially, Glaxo to leave ALEC alongside many of our peer firms, our sister firms. And Sir Andrew told us in this meeting, in fact, Trillium was there too, I got your letter, or rather someone within his organization got the letter. I went on the ALEC website, I read the first 7 objectives, and then I was asking, why are we a member of this organization? And they withdrew. So it's a great example of, we are concerned very broadly about third-party lobbying, about organizations which are funding activities which are inconsistent with their own stated positions. So this was a great example of us just bringing it to their attention. GSK has probably got 10,000 memberships globally, and I'm sure Sir Andrew doesn't know every single one. But that's an example of hey, you want to participate in this meeting, and obviously we can't accommodate 50 different people in the meeting, but we did have some of our clients along with some of our peer firms. The public example is a great example because you don't have to be one of our clients to get involved. So we're also at the moment working on, so the UN has come out with a set of guiding principles for reporting on human rights. And those principles are going to be launched in London on the 24th of February. We are coordinating an investor statement where investors will essentially endorse the principles and ask companies to report against them. So here's the guidance. Companies are not clear on what they should be reporting on. What are the disclosure requirements? We don't really know what you want. You keep on saying you want this. Here you go. Report on these issues. And Unilever is one of the first companies to pilot the reporting. And we're, in fact, likely to look to have an adopt a company, or we'd like to encourage companies in our portfolio to become, to endorse the principles and adopt them in terms of disclosure. So in that case, you don't have to be one of our clients. Just email me and tell me you want to add your institution and tell me your assets, and I'll put your logo on the letter. That's going to be but that's a public engagement. So there'll be a public investor statement, a letter that will be published. So your institution has to be comfortable with going public in endorsing this.